a capital structure. And after this video, we'll talk about more in detail about capital structure theories. Sorry, about capital budgeting and the different methods of capital budgeting. So let me share the video. Is it audible?
No, sir.
Can we share? Is it audible now?
No, sir.
Yes, sir.
Yes or no?
No, sir.
Okay. Is it audible?
No, sir.
Anybody idea what is a capital budgeting? Capital budgeting is a process where I will be telling about different capital structures and I'll be talking about how the investments are made. For example, if I want to start a project, if I want to do some activity regarding research, or if I have to make a huge investment, then I'm talking about capital. Why I'm making capital? Because here investments are going to be continued for more period. If I'm not able to analyze the returns properly, if I'm not able to judge whether they're giving returns in time or not, then that will create an issue to myself. So what I will do is I will first find out what are the issues, what are the things I require to take care. I need to find out what are the things I should plan about risk, what are the things I should plan about returns, about investment source, and so on. So in capital budgeting, I'm analyzing the different modes, methods, and procedures where I'm trying to study the various issues regarding understanding how much money I'm investing, how much money I'm going to get return, and how I'm going to arrange the money for this everything. So in capital budgeting, I am planning my financial sources in such a way that I'm able to get the money invested in proper way as return. Now, when I say capital, there are different types of capital. First, my working capital, then it is my fixed capital, and then it can be a theoretical gross capital and so on. So when I do capital budgeting, I need to understand the different types of capital, their importances, their relevances, and so on. So in capital budgeting, I'm planning, I'm planning to make an understanding how the money is going back, coming in, and so on. So basically, when I talk about capital budgeting, flow of income which I invested as a capital for long term, I need to find out how the revenue is generated. I have to find out how I'm going to repay it. I have to find out how I'm going to earn income surplus to the repayment amounts so that the amount invested will be able to regenerate it and repaid. So in capital budgeting technique of financial management, we have to learn how repayments are to be created, how money has to be refunded. Here we need to analyze how the financial planning, what we are doing, should make an influence towards payment of debts, towards generation of profits and cash cow creations. Now, all of you knew in strategic management, we have to take a call that how much money we invest. If we are not able to refund, then what will happen? That money will be on a burden and it will carry on a burden continuously. So to avoid that, we need to first think about how the repayments are scheduled and what are the provisions we are going to make. So sometime we have to make a provision that we need to analyze flow of money, we need to analyze revenue created, we need to analyze other sources and so on. So when I talk about capital budgeting, I talk about inflow, I talk about outflow, and I talk about how I'm going to generate the revenue out of it. So indirectly, when I say capital budgeting, I'm talking about the flow of investment from incoming and outgoing factors. So let me share the PPT. Is it visible now? I guess yes.
Yes, sir.
So I continue. In this, we have to study the definition of budget. Then we'll talk about types of budgets, but we're not going more in detail about types of budget. We're going to focus on budget, then capital budgeting, importance, its categories, steps, and so on. Let's continue. Budget is a management tool for planning and controlling future activity. So budget is planning for the future where I'm analyzing the things, what going to come in future, what and how I'm going to make the expenses in future, and what are the repercussions or what is the importance of saying. So in capital budgeting, sorry, in budgeting, I need to understand what are the emerging situations, what are the issues I'm going to face, and I have to plan properly. For example, suppose I'm going from A place to B place. I need to take care. What is the source to travel? How much is the cost involved? How much is the time involved? Whether I'm going with the one person, two person, or multiple person. Whether I need something as per my body language, as per my medical emergency, as per financial emergency. So every time I will understand what are the things I'm required, what are the things available with me, and accordingly I have to schedule my activities. It can be production activity, it can be transport, it can be food, or it can be any other. So when I schedule the activities, it is known as scheduling. And when I support this with the financial part, it is called as budgeting. So scheduling of various activities regarding my different objectives, aims, and making them work in a proper channel will be called as my budget. For example, if I have budget to purchase and or make an investment in X activity, then I need to make my plan so that it will not create a burden or I will should not be absolute. Because if I absolute, it will not be helpful me to work out. So in budgeting, I need to take care that what are the expenses I have that I will able to manage effectively and I'm able to repay the effectively. So in capital budgeting, what I'm going to do is I'm going to check the financial liability. I'm going to check whether I'm able to repay it in time or not. So indirectly, in capital budgeting, I need to analyze that what are the investments I'm going to make. They are generating the profitability or a product to me, and they are giving something return towards my source of income. So I need to plan accordingly. So this is about budget. Now let's move further. There are types of budget, like it can be production budget, it can be corporate budget, or everything. Now, types of budget depends on various. First, as per activity, it can be sales, it can be finance, it can be HR, it can be admin, it can be strategic budget, and so on. If I talk about period, it can be my short term, long term, medium, or others. So when I say about sector, then it can be my government budget, it can be my any other budget which I'm talking, like for example, event budget, personal budget, family budget, or anything. So it can be changed as per base of function, as per flexibility, as per time, as per source. So because we are not involved in types of budget, that types of budget part is covered under costing. So we are not going more in detail this time. We are going about understanding only capital budgeting. So let's talk about capital budgeting.
Capital is operating assets used for production, and budget is a scheduling of these all assets which are used for financing our activities. So, what I can say, capital budgeting is more than a planning for my future needs in such a way that I'm creating a particular flow of money. So, capital budgeting is defined as process of analyzing income and expenditures and making investment schedules to focus on decided objectives fulfillment. Or capital budgeting is a tool to schedule your investments for generating more wealth creation. Now, I'm not saying profit because profit is the ultimate aim of business. But if I'm able to generate the wealth, it is the wealth maximization what I'm interested for. Now, what is importance of capital budgeting? See, whenever I plan something, it always gives advantage. What is gives? I'm ready for emergency. I can take opportunity on risk capturing. I can take advantage that whatever the problems I'm going to face in future, I should be able to manage effectively. Then I'm able to maximize the output, whatever the feasible to my side, because this will help me to reduce burden on my side. This will give me an idea that what are going to be limitations, what are going to be steps, and how I should go about making them work properly. Second, because in capital budgeting, the amounts involved is larger, the period is also comparatively large. So in this case, I'm involved a large amount and large growth. So many people are involved, many expectations are involved. So complexity of decisions are there. So in these complex decisions, if my one decision fail, the chain of my decisions will be affected. So to avoid this effect, I need to ensure that I am able to make my complex decisions properly. Most importantly, when I go with a large amount of funds, I'm not able to repay it in proper because if I have short-term investment of suppose going for the daily cup of tea of 10 rupees, I can manage that. But when I'm going to invest in a flat, in a particular asset, machinery, I need to think about repayment. So considering all this, I need to talk about capital budgeting. So when I do the proper planning, I give justice to the source. I give justice to the how I'm going to repay the things. I'm able to talk about capital. And when I'm talking about capital, I'm talking about use of that money. I'm talking about application of money. I'm talking about importance and how I'm going to control the flow of money. I'm going to talk about how I'm repaying the money. And that is all about capital budgeting. So in capital budgeting decision, I have to take share that what is the money I'm getting, what is the cost of that. For example, bonds are 10%, debentures are 5%, then whether I should go with the bonds or debentures. Okay. If the bonds are cheaper, which bonds I should go with? What are the terms and conditions? What should be period? Whether I'm able to pay the interest? Okay. If I'm able to, then what is my charges and so on. So I need to focus how much money I'm borrowing and where I'm going. Then I should talk about how I'm going to use it. So first, I talk about source, I talk about application, and then I talk about repayment. Please remember the low repayment or low risky capital is always favored, and this can be analyzed by various means and tools of capital budgeting. Now, in first term in economics, you will learn there is something called as opportunity cost or cost of alternatives. What is opportunity cost? Instead of selecting A, if I select B, then losing A is my opportunity cost. For example, if I offer a cup of tea and cup of coffee to you, if you choose coffee, you will miss the taste of tea, and vice versa. If you choose tea, you might lose taste of coffee. So I'm losing one opportunity. Similarly, if you decided to go for civil services, you will not able to join the private services. You can join after some time, but initially you cannot. But if you join private services, you cannot work like government services. So alternatives you are going to make. So this is short example. So in capital budgeting, when I want to take a decision, whether I should take plan A, plan B, plan C, plan D, shall I buy or shall I produce? Shall I make it myself or shall I ask somebody to work? Everything is depend on profitability. Everything is depend on returns generated. And that tools are provided by capital budgeting method. So what are the important decisions taken? First, establishment of new products and services, replacements, expansion, research, long-term contracts, safety and environmental projects. If I'm starting a new company, new project, it might be expansion or replacement or addition. Am I going to make the profits or it's just an asset creation? I need to check. If suppose I'm giving one service and people are desire other service, so how many people required? Whether that actually going to work or some only people work and that create chaos. For example, now if I'm providing video calling to all my customers, but my question is whether that is required for all. If my that video call is used by all, whether that much bandwidth is available for all. So when I'm talking about investment in a fiber, I need to take call about opportunities available, benefits available of same. Because if the things are not used, if I'm not able to generate the revenue, then in that case, it is a fail. Secondly, if the maintenance or replacement is not available, then the things will be useful only once in a while. So it will be like a China products. I use it once and throw it. So in that case, I'm not able to generate any kind of revenue. So even the revenue generated, I will be at loss. I'm not able to make any benefits. Sometimes I go with the research projects where my income is not generated immediately. I do the research for 1 or 2 years, and after 1 or 2 years, I get the returns as new product or innovation. But before that, when I'm going with the research, I need to take call that shall I go with this type of research or not? Where I will do the analysis and I will find out how much is creatability and how much is available. Because if I'm not able to generate any revenue and only expenditure are made for research purpose, then that will not be wealth creation. That's only a scientific tool. When I'm entering in a contract for more than one financial year, there is always question about creatability. Because I can guarantee about 1 month, 2 months, 6 months, but in longer projects are there. I normally go with the bulky projects. I go with the decisions of heavy discounts. I go with the more and more trade involvements, more and more trade deposits. In such case, I need to take call whether I'm going with the right person, right quantity, and for right investments. So all these decisions are taken in considerations by taking in account my creativity, repayment capacity, and usefulness of that particular money. So, in case of long-term contracts, capital budgeting is also play a very important role. So, overall, application of money wherever is applicable is limited, and I need to take a call about arranging, utilizing, and rescheduling. In all these cases, I need to take a call about how I'm going to finance. And there, capital budgeting play an important role. Now, what are the steps of capital budgeting? The first, I need to check the visibility of an idea. What are the things I'm planning? I need first to check whether I'm going to able to give the output or it's just an idea. I want to go to the moon and start teaching from there so that everybody on earth can see my slide. Is it practical? Is it feasible? Is it feasible for only matric college or it is social? So I need to take call. Secondly, if I only start showing PPT and no explanation, is it practical? Is it feasible? And it will solve my purpose or not? I need to take call. Then I need to find out what are alternatives. Suppose I'm not able to go on moon and show the PPT. What are my alternatives? So first, I need to think about visibility of my idea, its practical application, and its alternatives. Once I find out the practical application and alternative comparison, I can take a call whether I should initially go with this or not. For example, if I'm living in Rajasthan and I want to start a tea stall, then I need to take call that whether I should be able to sell that tea or not. Now in marketing, it is said that I should be able to sell because I'm going to do marketing. But sorry, every time marketing will not work. Sometimes emotions and sometimes practicality need to understand. So what business I'm going to start, why I'm going to start, where I'm going to start, I need to take a call. I start a hotel, but there is no road to my hotel. My hotel is suppose 3 kilometers from a highway. How many people will come to my hotel? A question. If there is no board, how many people will come? I'm not talking about any beer bar. I'm just talking a normal hotel. So when I'm planning for something, I need to plan in such a way that it is generating revenue for me. Then what are the money I'm investing? Because if suppose I have money and I created a 5-star hotel and ask everybody to pay me 5-star hotel rent or 5-star hotel charges for their breakfast, people will not be more happy. They are not delighted because for them, getting the quality product is important rather than getting a 5-star service. So I need to take in call about people's mentality, their likes, beliefs, and choice. And after that, I'll talk about what are my alternatives. Whether I should go with the restaurants, I should go with the lodging, or anything other. So considering this, I will take a call and analyze what choice I can make. After these first three things, if I take a call, then I can make my decision now to find out source of finance. As I said, in net income approach, net operating income approach, and MM approach, that it can be my own money or it can be my borrowed money. If my own money, then what are repercussions? What are charges? If it is my borrowed money, what are my charges? And so on. So I need to take a call about how much money I'm borrowing, how much money I'm spending. So indirectly, when I'm taking a call about the same, I need to understand source of my investment. I have to find out alternatives of my investments. And based on tools of capital budgeting, normally we have three. One, payback period. Second, net present value. And third, time value of money. We take a call whether I should go with this investment or I should postpone with this investment. Then, after analyzing financials, after analyzing projects, I will take a call about validity, profitability, and sustainability of a project and steps to understand its controllability. And after all audit and reports, I analyze and then I'll take whether I should invest A, B, C, and D. So basically, in capital budgeting, I take a call on three terms. It's valid, sustainable, and generating income. So if it's valid, sustainable, and generating income, I will do that project. Otherwise, I'll search for the other things. Now the question is, sometimes it is not so good. So when it's a social cause project, normally as an entrepreneur, I give up because my interest is not for social activity. Huh. If my projects are funded by some government authorities, if I have some CSR funds, if my government reservations are there, or if I'm getting tax concessions, in that case, I can talk about social activities, but normally social clause is not applicable when I do fund investments. Now let's talk about what are the different evaluation criteria. Now there are two things. One is discounted and other is non-discounted. For example, if I'm talking about return after 5 years, then the value of money after 5 years will be lower than the current one. For example, when you was in 10th standard and you was eating, suppose, oh, sorry, you are drinking a cup of tea. That time cup of tea was 5 rupees. Now cup of tea is 10 rupees. After 5 years, the same cup of tea will become 20 rupees. So what is the change? The tea quantity is not changed, the taste is not changed, but the value is changed. The value of same quantity of tea is increased from 5 rupees to 20 rupees. It means the value of money is declined because for same cup of tea of 5 rupees, you are paying 20 rupees. So its value of money is declined by 15 rupees. So when I go in future, that is in forward, my value of money always go down. So normally if you see the LIC investments, it shows that after 20 years you will get 1 crore. But when you're getting 1 crore, the value of money is not 1 crore. It is actually less than that. So it is called as a discounted. Whereas if I'm getting any money immediately, it is not discounted. Why? Because returns are generated within 1 financial year or 2 financial years. So within 3 financial years, if anything I received, the effect of value of money is negligible. So it is ignored. So basically, discounting criteria is applied when time value of money is larger than 3 financial years, and non-discounting criteria is used when my flow of money is within 3 to 5 years. Because when I investing and when I getting return, there is change in financial position. For example, there are some businesses which started in 1850, and now their investments are giving 1 crore or 10 crores. But when they started 1850, the value of investment is 10,000. But please remember, when they started investment 10,000, that time the 10,000 was valued something different because in 1950s we have something called as 1 say 2 So that time value of 5% was more than our 50 rupees. So equivalence, if I give it, I am having more value. So we'll be talking about different evaluation criteria based on discounting and non-discounting. So basically, discounting is about understanding the future values, and non-discounting is understanding values between 3 to 5 years. I just introduced what is the terms. The payback period is a method where if I borrow some amount, how I'm going to repay and what is my payback period. For example, I borrow 5 lakhs. If I'm able to repay the 5 lakhs in 1 or 2 years, then my investment is good because my returns are getting good. So if I invest in X factory and the factory able to give me returns in 2 years, then that factory is doing well. But suppose if factory is taking 20 years, in such case, my returns, my money is blocked for 20 years. So the project which gives me lower payback, I'm accepting. Then accounting rate of return, or it can be called as average rate of return. In this case, when my returns are more than my investment percentage. For example, if I borrow loan of 8% and my returns are of 20%, then whatever the investments I have made, I'm getting higher amount of returns. And that higher amount of returns, I can compensate my interest part and have surplus money with me. So that surplus investments, what I'm enjoying is more profitable. So higher is more. Whereas in case of discounting, The first is internal rate of return. The internal rate of return is again like interest percentage, but here we find out something called as a discounting factors. Now, over the period, I will make you the formula for discounting factor, and then we can talk about more in detail. So, in case of non-discounting criteria, we normally talk about shorter payback period and higher returns. Where a discounting factor, we talk about net present value, that is, investment is deducted from income, and how much more income I receive. More the net present value, good is the project. Then profitability index is like index linked with uh, product, where I assume that the first year is a base year. So first year I assume 10%, second year 20%. Then I'll go accumulation of index and analyze how much I'm getting the returns. If I'm able to get the returns of 100% in 4 years, my property index outcome is 4 years. So lower the index, more the better. In case of internal rate of return, it is parallel accounting rate of return. But the only difference is that here net present value is calculated on PV ratio, that is discounted ratio. Now, let's talk about the first method, payback method. Till now, anybody has any doubt? Okay, I have no doubt. Then I'll proceed further. The first method of capital budgeting is called payback method. Let me show a whiteboard, share whiteboard with you. Sorry, instead of whiteboard, I'll share the Excel sheet because it will give more help to understand. So I'm sharing the Excel sheet. So my investment is 50,000, and then my profits are as below. So if suppose these are my years, and these are my profits I received from investment. So how much money I invested? 50,000. And these are the incomes which I'm generating. So I have to find out in how many years I'm able to pay the 50,000. So after 2 years, if I combine here 8,000 plus 5,000, it is 13,000. After 3 years, if I combine 12,000 plus 8,000 plus 5,000, it is 25,000. After 4 years, it is 38,000. After 5 years, it is 53,000. So it means I can get my investment back in 5th year. So my payback period will be 5 years. Now, how to calculate exact 5 years? So in a year, there are suppose 365 days. Now, up to 4th year, my amount return is 38,000. So 38,000 I can recover in 4 years. So how much I am able to recover? So extra I want in 12,000 in 5th year. So in case of my 5th year, in 365 days, if I getting 15,000, I have to find out in how many days I'm getting 12,000. Okay. So what I'll do, 365 into 12,000 divided by 15,000. So days are 292. So it means the amount of 50,000 is recovered in 4 years, 292 days. So the amount which I invested as investment, 50,000, I'm getting paid back in 4 years, 292 days. So this is nothing but my payback period. Let's take another example. My investment are 5 lakh. I have two options. So first is yes, then option A, option B, and option C. Then profits are 50,000, unlike here profits are 40,000, 50,000. Your profits are 0. So I'll just drag this. So these are the three options I'm having. Now, where I should invest and how I should invest. If I see my investment is of 5 years, and as per payback method, if I'm able to recover the money easily, then that is profit. So if I take first A as my option, then 1,50,000. So 3 lakhs a year, and I'm able to recover money in 4 years. So for A, my return will be in 4 years. But in case of B, it is 120, 240, and it is 4 year plus something. So it is 4 year plus month. So it is 120, 240, and sum of year. So for this, I'm getting this as my payback. If I calculate for C, first 2 years, it is 1,20,000. Then it is 2,50,000, and it will also go here. But here it will be 4 plus months. But if I just check, the project C will be more cheaper. So I can rank, this is number 1, number 2, and number 3. So when I want to make an investment, I need to take call on returns. So when I'm taking a call on returns, I find out that in project C, for the total of 5 years, it is 6,75,000. For B, it is 6 lakhs. For A, it is 7,50,000. And I can recommend that A is generating higher income. It has a low payback period. So on an investment of 5 lakhs, if I want to make a decision, my first choice should be project A. My second choice should be project C. And if any money remains and I'm interested, then I can go with the project B. So this way, I can take a call of payback period. Now in this payback period, whether it is profitable or not, good or bad, these all decisions I'm ignoring. I'm just concentrating on how much money I receive. So in payback method, what I'm doing, I'm just calculating the flow of income against my flow of expenditure and how much I'm doing. So the inflow and outflow is analyzed in payback method. Better the early, I take a call that how much money I am receiving, and based on that, I will decide project is good or bad. If I want to choose multiple projects and having extra funds, then I will take call on the basis of their returns. If project B and project A and C, they are only 2 projects I want and they are giving returns, I may not take call of project B. But if I have extra money is available, I can take call about project B. So considering all these factors, I need to understand whether I should go with the A or B or C. So this is the formula for capital budgeting, and this is the explanation. Anybody has doubt about the same? Let's move for the next method. It is called as accounting rate of return or average rate of return. Now, this is only importance about profitability. As per this, profit after tax divided by initial investment, I will find out returns. Now, let's go back to our example. I'll again reshare the Excel sheet. Now, if I calculate the total profit generated here, so project A is higher returns, project A has 18 lakhs, project B 14 lakh 40,000, project C 16 lakh 80,000. So what is my investment? It is 5 lakhs. So the net return will be my returns minus investment. And now I assume that 50% is tax. Now it is always higher. So I pay the tax and profit after tax will be so if I find out returns, then this amount divided by my investment into 100. So this is 130%. And if I work out here, I will find out the project B 94% and project C 118%. So in case of project A, payback period is short. In case of B, second short, and in case of C, the lowest one. So the best project I can choose is project A. So this is my accounting rate of return. Anybody has doubt in this? So let's go back to the formula. I find out profit after tax divided by investment. The higher the return, more the profitable. So today we talk about capital budgeting, why it is important. Then we talk about the first two methods. They are non-discounted. Then we discuss about what are discounted and non-discounted. And I just illustrate two methods. So capital is the last sum of money required in one accounting period, having complex and irreversible decisions. So we need to take carefully. So when we plan for the source, application, and utilization of capital, it is a capital budgeting. There are basically two methods, one is discounted and non-discounted. The discounted methods are payback method and accounting return or average rate of return. In this payback method, we calculate how much is payback period. Lower the payback period is a greater thing. and higher the payback period, it is not welcome. When we are calculating payback method, we should able to understand how much is lower and whether I'm giving it more profitable. So in payback method, I concentrate over less period generating more income. The second method we discussed is average rate of return, which also can be recognized as accounting rate of return. As per the second method, the profit available after payment of interest, tax, everything for investors is important. So in this method, I find out the profit available if higher, then that project I should select. So both these projects ignore the concept of time value of money, but they only concentrate on returns generation. After this, we have to talk about the most important discounted cash flows. So for discounted cash flow, we need to talk about present value. So next lecture, we'll talk about PV factor, how to calculate PV factor, and then we'll discuss about the discounted methods of capital budgeting. I'll try to share the video next session. So anybody has any doubt, they can ask me. No doubts. So thank you all of you for being part of this session. And be present for the evening session on direct taxation. We're starting new topic. So waiting your all presence there. So wish you a wonderful time. Good day.